There are several different kinds of bank accounts that your bank can open for you. Certain ones are called DDA accounts. That means demand deposit accounts. Those are your checking account and your savings account. What that means is you have opened a bank account with money, and since it has been opened, you have made deposits of cash. You have made deposits by check. Maybe you have your payroll check direct deposited, and those are funds that are in the bank. It's money that belongs to you that you have paid into the bank. It doesn't mean that your money is sitting in a drawer, the exact money that you deposited, waiting for you to come back and get it. Once the money is deposited with the bank, then the bank is under contract to make it available to you. Since the stock market crash in the 1930s, there were additional rules and regulations implemented so that people's money would be secure in banks, and there we have the FDIC insurance up to $100,000 per borrower, per person in a bank. So keep that in mind. It applies to your account. So you've accounted the bank, you've got $100,000 in insurance. What that means is up into $100,000 of your money in your account is protected. If you have $1 million of money in a bank account, an FDIC insured bank, you are protected up to $100,000. So there are other arrangements that you can make to protect the amount over that $100,000, and I hope you all have that problem, but you're secure up to $100,000. And the purpose for that is, if you know your history, there were runs on the banks and everybody wanted to go get their money out at the same time. Well, guess what? It wasn't there, because that's not how banks work. So demand deposit means you put it in, and on your demand, your deposit is to be available to you. So those are checking and savings accounts. Then we have money market or IRA or investment accounts. Now, money market, you can think of it in a couple different ways. A general way would be an account where there's a money market rate of interest. And so that's more akin to a savings account, and there may be additional restrictions on that as far as how often you can transact business on that account, etc., to really make it worth your while and the bank's while to deal with this. And then, of course, a savings account. An IRA is an individual retirement account, and there are certain tax rules that apply to that. That's usually a one-way in until you reach a certain age, and then it's a one-way out. So you're making deposits into that account, and your after-tax money is earning interest. And then once you hit a certain age, then you can start withdrawing that money without penalty. But there are big penalties if you're too young and you try to access it. And then you have investment accounts, which would maybe brokerage accounts. Where you would have a bank account related to pay fees and charges in connection with your investment account, which is an account where you have money invested in the stock market. Okay, so those are your basic different types of account. Now, people wonder, and my employees ask me, why can't I go cash my payroll check and get my whole amount? Well, if they go to the bank where it's drawn on, they can, because the money they go to the bank where the money is, and the money comes right out. If you have a account at ABC Bank and your employer has an account at XYZ Bank, then you deposit it. You take a paper check to the bank. Then you are subject to the funds availability rules, and these are rules set up by the government to oversee the banks, and then the banks have their subset rules that they then implement. So it's your funds availability policy, which is something that you need to pay attention to when you open up your bank, because it tells you how long you have to wait until that deposit is 100% available to you. There is usually a percentage of that amount that's available to you immediately, regardless of what your bank balance is. And then depending upon how much money you already had in the bank when this additional check was deposited, will allow additional funds to be available immediately upon the deposit. Now, the reason that there's a funds availability rule is because of the way money goes through a bank. We have the Federal Reserve System of banks here in the United States, and the banking, while a lot of it is now electronically, we used to have check proofing and different ways for things to go through clearinghouses, but If I write a check on my bank account here, I am writing a negotiable instrument, and it is instructions to my bank that in another video I'm going to show you, what the information on a check means and how you can find that if you're ever curious. But it's instructions to my bank that I make about my account. And so if you look at the check, it says pay to the order of. That means it's not negotiable that way. It's telling them you pay this money to the order of John Doe. And it says to the order of, which means John Doe could endorse the check on the back and have it paid to someone else. So it's pay it to John Doe or who he directs you to pay it to. And then so I give John Doe a check off of my bank account. John Doe then takes it to his bank to deposit it. So his bank takes it in, they give him a provisional credit. So it's kind of like it's in pencil. So that amount is added to his balance, and then they tell him how much he's available to take out right away. And that's because they don't have the money yet. They have the instructions, but they don't have the money yet. And we have clearing, midnight deadlines and clearing times for banks to transfer the money. So his bank takes in the check, gives him a provisional credit on his account, and then they send it in. They send in the check. The check then goes back around to my bank, and my bank sees it. They check the balance in my bank account. They make a notation, pull that money, deduct it from my balance, and they send the money to Joe's bank. And then that's a final credit. When my bank has paid it, it's a final credit to his bank. His funds are released. And that's why, because that's how the money is actually transferred. So hopefully next time you go to make a deposit, you'll understand this, and that is why direct deposit is so popular, because direct deposit is a payroll function where there's extra fees incurred. I know I'm an employer, so I pay extra fees, but those are done so that the money is transferred from one bank to the other directly. There's no in between, and there's no waiting, and once the money hits, it's 100% yours. Okay?